Hi everyone, this is Lan Ewan and Phil Ewan here at Success Wealth, and today we have a special guest, Shae Russell. Welcome, Shae.
Thank you for having me, Lan and Phil.
Yeah, how are you, Phil?
I'm really good. I'm so excited about today. This is one interview that I've been really looking forward to.
It's at that good time of year because Shae is in the gold and gold mining space, and we've got her in time where gold is doing some wonderful and crazy things at the moment. But before we get to that, I'll get Shae to introduce herself to the community for those who don't know a lot about yourself and what you do.
Yes, okay, so obviously my name's Shae Russell and I'm from Fat Tail Media and I'm a wearer of many hats. So I've got a few newsletters that I write. One of the ones is our free one, which is the Daily Reckoning Australia. I'm the chief editor over there. And basically, we take a contrarian approach in that newsletter, and it's all about providing macro analysis, but pointing out what actually matters to Australians, because a lot of economic commentary I've found over the years is very US centric. So that's all well and good to keep abreast of US events. It is very important, but we try to boil it down for what the takeaway for Aussies is, but also to, just push past what the rhetoric is that you're seeing in mainstream financial publications. I actually hate using the word mainstream, but often I find that sometimes, the financial rags around Australia don't quite get to the point, or they're all, have a consensus view. So we try and point out a contrarian point of view there. So something that you're not always hearing out in the press. The other two newsletters that I run are subscription-only content. One's the entry level, Rock Stock Insider. Basically, it's the basics of understanding why gold is important, why everybody should own precious metals. I recommend a few stocks in there, but I think the most valuable point of that service is that I speak to experts from around the world and I share, their views. Often they have contrarian views as well with subscribers as well. And then there's the highly speculative service. It's certainly not for everybody. And it's all about, high risk gold exploration stocks, well at risk of overusing this joke, but, over at Hard Money Trading, we're recommending, that the guy and the shovel somewhere out in Australia, we're recommending those stocks. So yeah, I get up to a few things.
Look, that's fantastic. And I'm a follower of your work, and I love how different levels of writing for different levels of investors, because you're right, because it is a high risk area, especially the explorative mining stocks that you do your research on. But tell us a little bit of how did you get into gold mining stocks? Like what made you get into that area in the first place?
Yeah, look, it was sort of a flow-on from my love of gold, and it turns out later in my life I developed an unnatural love of rocks. So I'm basically a rock nerd, and I didn't know that. So obviously I've been investing and recommending and writing about gold for 15 years professionally. I've been an investor in gold since quite young, and I was fortunate that my old man taught me about the benefits of gold and that it actually used to be money. So gold has always been, my financial foundation, for lack of a better way of putting it. And it was only as I got a little older in my late 20s, I went to the bank and cash and gold sort of thing, that I started looking more and more at the mining stocks. And then a few years ago, with my publishing company that I work for, they needed a gold mining analyst. They needed somebody to cover the mining sector of the market. And it had been an area that I'd been following for quite some time. I was naturally drawn to it. I really love understanding the geology of what's underground, so much so that I've gone back to school to study it. And that really, was sort of the morphing of a personal interest. And I've been able to write a career on it the last few years.
I guess, having a passion for rocks, and obviously you actually go out to the mining site and see what's happening behind the scenes, right? Is that right? Or you get to meet and talk to the mining directors and
Yes and no. So I try not to get to a mining site pre-recommendation. And that's simply because I don't like any companies knowing I'm sniffing around them. I've got people that I speak to who know companies, who know projects, and they're part of a network that I trust. But the industry, particularly in Australia, is very, very small. So I don't like, I'm talking about a lot of the companies, the speculative companies that I recommend are in the sub 50 million category. So it's very, very small, and one word that a certain analyst is out there, whether it's me or somebody else, and you can see speculative money roll into it. So I don't like doing that. Obviously, this year I had planned a couple of site visits to companies that I had recommended, but COVID has disrupted a lot of things. So hopefully next year there'll be more site visits planned, but I tend to only do them after a recommendation has been made, and I tend to only speak with companies also after a recommendation has been made, because sometimes pre-recommendation you'll find that some companies might be a little bit more sales-like rather than informative. And I have my network I rely on. I can spend 50, 60, 70 hours on investigating one company before recommending it. So basically, I take the information that's publicly available, I verify it past my sources, and then I move to a recommendation. And only after that will I seek to get in touch with the company, and then hopefully get to a couple of mine sites next year, maybe.
Yeah. And I know that because you're so authority in the space, as soon as you recommend something on your newsletter, the price goes up 10% straight away, or 20%. So
yes.
So therefore, you must have to be very careful before you say something, because the speculation from investors already from your recommendations. So do you find that often, or is it just as soon as Shae recommends, then prices go up? If Shae says this one a stop loss, prices adjust as well accordingly. Shae, look, I've just saw that the last few weeks gold has been acting a bit weird in terms of the price, and we are meant to be in a bull run in commodities right now. What can you share with us? Because your last article, you said, how low can gold go? So share with our community what's happening with this gold price. Like, is it just taking a breather, or what do you see happening?
I've got a chart that I will share with everybody in just a sec, because it's quite technical, so I'll go through it. But the first thing first is, I certainly believe gold is in a good gold bull market. It pauses along the way. And this is something that if you go back through history, you can see that, it's the old adage, nothing goes up in a straight line. If you look back at the 70s gold bull market, which was quite strong, there was a 2 to 3 year period of time where gold looks like it was going sideways. Years gone by, between 74 and 76, it looked like it was going sideways, but really the gold price was just sort of finding support before it moved upwards. Before the real catalyst to move upwards was there. It's a similar thing that happened in the 2000 bull market. Between 2004 and 2005, gold only rose slightly, and then again between 2006 we started to see that next strong leg up. And what we're seeing now is very reflective of 2004, 2005, 2006. We've had that really strong leg up, but now we're going to see the gold price come back. Now, perhaps a little too boldly, I declared in a company-wide meeting a couple of weeks ago that I believe the next couple of months are going to be your last chance to buy gold under US $2,000 per ounce, which maybe I'll look foolish a few months from now. But the pullback we've seen recently in the gold price, and I'll just share my screen. All right. So can we see my screen, everybody?
Yes.
Okay, so I'll get to the technicals of what this chart actually means in a moment. I'll just draw your eye down over to this point here. If you can see my cursor, it was a little cross, now it's changed to a hand. So this is where we saw gold sold off to recently, and that was down to $1,765 per ounce. So this is the sell-off that's rattled a few people's faith in the gold bull market recently. And this is very much a reaction to not one vaccine, but 3 vaccines coming out. And for lack of a better word, there's this idea that risk is back on in the market, and we don't need an old relic like gold. But you can see that the gold price has had this quite strong bounce as it's come out of it, and we're now back up $100 more, $1,860 or roughly where it is today. It was merely a pullback, but the reason why I'm showing you this particular chart is I've got a Fibonacci retracement overlaid the gold price. Now, what I've done is I've taken the March low, so pre-corona, in the middle of the coronavirus panic, right up to that August price high, which was, it's actually in intraday trading, it got as high up as $2,080 per ounce, but this is just set to the closing price. Now, so what I've done is I've overlaid this Fibonacci retracement, and the reason why I do that is I find a Fibonacci retracement is quite helpful when it comes to looking for turning points in the gold price. And Len, this is probably what you've seen me talk about over the past few weeks. Now, generally speaking, in any sell-off, I look for a 50% retracement. So that would be bringing us back down to this line over here. And so as you can see here, it's sitting around the $1,770 per ounce price. Now, that is almost exactly to the beat what gold went and did. Now, when gold bounces back down to the Fibonacci retracement from a high on a low, it's a very bullish signal. Now, it doesn't mean that we're about to see a huge surge once more. It just suggests that the bull market trend is back intact. So now that gold, sorry, I'm waving my hand around up here. Now that gold has bounced off that 50% ratio, the next ratio that I was actually looking for to say whether the bottom was in was actually the 38.2 ratio. Now, gold has briefly crossed it by 2 trading sessions. If it can hold above this level and trade between, let's say, 1842 and around 1890, if gold trades between there for the next few trading sessions, I will go back in time and say, yes, clearly 1770 or 1765 was the bottom in the gold bull market. But if gold bounces back down and even slightly under this 38.2% retracement here, so, you know, back under the 1830 mark, I would say that we're going to see a sideways pattern into the rest of the year. At this stage, I still think it's a little bit too soon to call what's going to happen, but I wouldn't be surprised to see gold trap between about 1880 and this 1806 level for the next few weeks. But one more thing, just to bore you with my little fancy chart that I do love. If we see gold move back up over here, which is the on the Fibonacci chart, it's a 23.6% ratio. If we see it move back up here, so around about 1920, and again, you see gold above here for, you know, let's go 5 trading sessions or even a week of trading, I would say that the next leg up of the bull market is coming, and we're going to see gold take surprising stabs at that high. But I wouldn't be expecting that until January, February next year.
So even with these vaccine coming out that work, like let's say a vaccine does come out and works, you still see that happening with gold and the bull market?
Yes, certainly, because look, gold was in a bull market even before the coronavirus happened. Gold's been in a bull market since December 2015. I know, you know, some people have a different idea of when it started, but that's my take, and believe it or not, that's because it's a 50% retracement from the 2011 high. We've got to remember here is we're in a monetary experiment where central banks are really trying to maintain steady growth and smooth over business cycles. And the problem is, in order to do that, they're doing it with a fiat currency and, you know, essentially printing money through quantitative easing. Now, these are all things that are quite strong long-term in supportive environments for gold. Now, arguably, I would say that the monetary system effectively broke in 2008 on the back of the financial crisis. That's when we started to see unprecedented measures filter through. Now, the repercussions of that are only just starting to play out now, and I believe that gold is still reflecting what happened over a decade ago. So even though we've had these vaccines come out, it's a short-term disruption of a long-term trend. You know, I think we could be looking at you know, 5, 6, maybe even 7 years of a gold bull market left to run.
Phil, did you want to add anything before I go to?
Yes, there's a lot of macroeconomic forces that you're saying at play that are still playing out and will continue to push the market in that direction.
Absolutely. But more than anything, it's a reminder of nothing goes up in a straight line, and we're still, by my reckoning, if we go back to 2015, we're still only 4 years into a very early gold bull market. So gold is on the precipice of about to do unfathomable things. From here, we're going into no man's land. Yeah. So even, you know, for analysts like myself who's, you know, been in this industry for a very long time, we're now moving to unpredictable price points, and that is because gold is going to reflect the unpredictable and unconventional monetary policies that we're seeing coming out from governments and central banks.
Yeah. So playing devil's advocate a little bit. So what happens to the narrative around the manipulation of the gold price itself, and the parties to be that don't want the gold price to go, because, you know, the way what price is agreed to every day is not through a free market system.
Right, I'm going to completely rip off another analyst by the name of Bronson Check. He came up with a great analogy, and I think we should all look at it like this. So yes, you know, when you trade, there are ways of manipulating a price, but it really is only a short-term thing. But as Bronson Check pointed out in one of my interviews once, when you're going to buy a car, you don't tell the dealer how much you're willing to pay for it, and he doesn't tell you how low he's willing to go. So there's already psych out games being played by you know, the two parties in that, trying to find the lowest price and the highest price possible at the same time. That's very much what you see traders doing in the futures market, because the futures market now dictates the gold price. So on a short-term basis, absolutely, we do see traders basically trying to psych each other out of who's willing to pay the least amount and get the most amount of gold at the same amount of time. The problem is that's very much a short-term, day-to-day force, and it only works for so long. Eventually, something has to give. A lot of that something has to give, for example, if we look back in March, a great example of that was physical demand was far outstripping the supply of gold. You know, supply of gold, physical gold, is very, very hard to get. And as a result, we saw, you know, there were arbitrage opportunities in the futures market back then because the supply of gold had actually been fractured because of COVID. That couldn't be manipulated because that was the market forces at work. So while there are certainly short-term factors that influence the gold price, the long-term physical demand for gold, I believe, will trump that short-term intervention.
Okay.
Yeah. That applies to silver as well, isn't it? With the spot price of silver is being widely known, and that it's been manipulated. So I guess what I want, can that be resolved in, you know, in the future, do you think? And what's your opinion on that?
Knowing traders the way I know I do, again, it always comes down there. They want more for less, and they always want to do it for themselves. If you're interested in the manipulation of the silver price, a great guy actually to find on the internet is a gentleman by the name of Andy Sheckman. He runs Miles Franklin Precious Metals in the US, and he's done some great work on JP Morgan cornering the silver market, and he does it without a conspiratory tone to it. So I do highly recommend his work. I do think this is where I become an advocate for owning precious metals over owning paper metals. I know a lot of people do like to invest in ETFs when it comes to gold and silver to, you know, take advantage of the price differences. I personally don't own any shares in any gold or silver ETFs because the way I see it is I would much rather own the physical, because that is where the real value lies, and that is also one way of removing yourself from the manipulation, the short-term price manipulation. So any gold I bought 5 years ago is my gold, and it's cash stored that way. But also too, then I'm not overly concerned about how much my portfolio is worth each given day, because I know I hold the physical and I can go sell that at any time that suits me.
Okay, for those who wanting to know, like, should you be, because you mentioned holding it physical, there's other ways to expose yourself to gold and silver, which is unallocated stocks, which we'll get into that soon. So can you share with us what's your percentage of allocation in across that, and any other alternative assets like property? I know property or crypto at the moment is quite trending at the moment. So can you share general advice, of course, but to our viewers, what allocation do you hold in those assets?
Okay, so I am very bullish on gold and silver, and I would not recommend my percentage of holdings in gold and silver to anybody else, obviously, because I'm quite aggressive. But I would be at least 50% of my net worth in gold and silver. And incidentally, I'm actually heavier gold than I am silver. And the reason for that is I'm trying to trade the gold to silver ratios, which is basically how many ounces of silver it takes to buy 1 ounce of gold. It's whether there's merit to the theory or not, I believe it or not, I won't know for a few more years, because you've got to wait for the silver to gold ratio to fall, and these are often, you know, multi-year flips that come forward. I haven't been able to flip my silver into gold yet, but that is why I am heavy silver, because I do expect the silver price to rise significantly in the future, and when it does, it tends to outpace gold's rises. So I'm quite aggressively in the gold physical net worth in gold and silver. Other than that, There's shares. Look, I'm going to be general only, but I am invested in the large miners in Australia, in the gold miners specifically. I'd say I'd have about 10 to 15% of my net worth in those. I am the proud owner of $50 of Bitcoin that I bought at the absolute height of the bubble a couple of years ago. And as I mentioned off camera before, I've also lost the encryption key to them. So though that $50 worth of crypto, I will probably never see again. The rest is in cash. And for now, the simple reason the rest is in cash is to be nimble, so I can take advantage of more opportunities that come along. I know, and we are speaking obviously general in nature. Cash can sometimes feel like a dirty word in the investment world. Everybody has this idea that you must have your money and you must grow your money and it must be doing something for you. The downside to that is if you put it all into assets, you lose the ability to be nimble when the market presents opportunities to you. And they could be a wide variety of things like art or gold and silver or property or stocks. Personally, I'm into alternative assets. I'm hunting down very old historical maps at the moment. So I'm, keeping cash on the sideline so I can invest in those. But I'll just point out that there's, if I invest in those things, I'm not going to see a return on them for decades. So it's not something that you invest in now for a short-term reward. So my investment strategy is different to other people's. I'm not investing to grow my portfolio in a year. I'm investing on, well, what can I pass on to my children that will grow their net worth? As for property, I'm not actually in property at the moment. As I just explained, I'm quite heavy in gold and silver. But I do plan to buy a retirement home somewhere out in gold country where nobody can ever find me.
Fantastic. And you mentioned gold and silver ratio. What is happening at the moment? Because I know the last time I checked it was 70-80, but has it gone? And why are you more heavily invested in gold now than silver? Is it because...
Okay, so I'm more heavily invested in silver than gold at the moment, and it is because of the gold to silver ratio. Sorry, I didn't actually check the gold to silver ratio before I came up on this call. Didn't realize I was going to bring it up today. So the gold to silver ratio, the idea is that historically, silver and gold gain at different rates. And when silver does gain, it moves at a much, much quicker rate than it does to silver. Now, what that means is the gold to silver ratio fluctuates over time. So sometimes you can buy, let's say, sometimes you need 70 ounces of silver to buy 1 ounce of gold. And at other times you might need 80 ounces of silver to buy 1 ounce of gold. Now, the higher the gold to silver ratio goes, that's telling you that silver is undervalued compared to gold. And the lower the gold to silver ratio goes, that tells you that gold is undervalued compared to silver. Now, the historical average is that it should be around 50. I've done a lot of work criticizing that recently, though, because that's based on a monetary system that doesn't exist anymore. When people look at the gold to silver ratio, they take it back to the Bretton Woods Agreement when gold anchored the money system. It doesn't do that. So I prefer to look at it from the 1970s forward when we've been on a fiat currency system. And the gold to silver ratio from about then sits around 60. Now, taking advantage of the gold to silver ratio is about waiting for gold to be undervalued compared to silver. So if you see the gold to silver ratio fall below that historic norm of, say, 50 or 45, that means you can swap your silver for gold. But technically, if you're doing it 45 versus 70, it means you're going to get more gold for your silver swap than you would if you did it at 70 ounces of silver for that 1 ounce of gold. It's got, as I said, it's sort of a multi-year trend, and that is why I'm in it, just because it's sitting at 75, which is outside historic norms, even going back to the 1970s. Personally, I'm an opportunist, and I do hope that if the ratio comes down to that sub 50-45, I will be converting my physical silver into gold. It's sort of, it is a useful strategy if you're nimble, and also when you watch the market, because that opportunity doesn't present itself very often. And when that window opens, it's quite small. It doesn't last very long. It really only lasts for about a 4-week period. So it's certainly not for everybody. And also it wouldn't be useful for people who hold their physical gold and silver at home, which I absolutely do not recommend, by the way. If you are going to employ the gold to silver ratio trading strategy, you would definitely want to make sure that your bullion is stored with a gold bullion dealer and that they have a nimble sales process, so you can, sell your gold or silver at a moment's notice and they arrange the transfer for you.
Yep. Fantastic. So it's at 75 at the moment, yeah?
Yeah, 75 at the moment. Yeah, dips down to under the 50. I'd be very keen to swap my silver into gold.
Then silver's undervalued then, is that right?
Yeah, I would say silver's undervalued. Again, not a price I checked before I came on here, but I definitely think silver's undervalued. Especially too, we've got to remember we're investing in Aussie dollars, and I do have the habit of talking in US dollars all the time. So it's at 24 US dollars, but because the Aussie dollar is absolutely flying at the moment, silver's come down to $33 an ounce in our currency. So I certainly see a lot more opportunities in silver right now because of the strong currency and the prices come off the boil. So I would definitely argue silver is cheap in relation to gold right now.
Fantastic. So a lot of opportunities there. And, recently we had in advising clients to, when in self-managed super funds, people are taking up a small allocation in gold and silver, particularly unallocated. Now, do you find unallocated equally as reliable good as physical? Because they're in an investment long-term, so they don't really need the physical to hold.
Look, I think both have merit. Pooled and unallocated both have their merit. For starters, unallocated is cheaper. So why would you want to increase your fees and pay more for pooled when you're really getting the same amount of same thing? The other advantage to unallocated is obviously it's easier to just sell, say, your gold for silver if you ever wanted to, or vice versa. Pooled is really only useful if you're storing your bullion dealer who will let you redeem it for the physical. But even then, you'll pay casting fees or refabrication fees, I think they might call them. So if you're after absolute bang for buck, unallocated is the way to go. All Australian bullion dealers have incredible reputations. I know a lot of people in this industry, and I don't have a bad word to say about the people I know working in this industry unallocated, and not once has anybody not redeemed their, not been able to redeem it or not got their money back. So as secure as you can get, as I'm legally allowed to say, but it's absolutely the cheapest way to do it. Some people prefer pooled because there's that additional sense of security, basically paying a higher cost to sleep at night.
Yeah, I think for the first timers or newbies, they do have maybe a question around unallocated, whether if they one day see their bullion dealer go down or bankrupt, or and who do you follow or chase up, especially during that COVID time, and you can't really get your access to your physical anyway. So yeah, it was just a question that some of the investors had, and I think you've answered that.
Much is a great example of patience. So when you talked about how some people had questions around pooled versus unallocated, so a lot of people, I'm not going to name names because I don't want anybody to think this is, I don't want any suits coming after me. But for example, a lot of people tried to redeem their pooled allocation in a hurry. They tried to get it pulled out and have it refabricated. So what you need to understand about the gold stored in bulk is that they store it in 400 ounce bars. So if you want your 4 ounces, let's say, for example, out of that bar, you go in a queue until there's 400 people or 400 ounces worth to melt down, refabricate, and then have shipped out. Now, I know back in March, people were reclaiming their pool, which is absolutely fine, but it was taking them 3 to 4 months just because the demand was so high to reclaim the physical for fabrication. So my answer is, if you're so hell-bent on having physical gold in your hands, then that's probably the best thing you could do. But you don't want to be calling up in times of stress and asking to have your pooled allocation and taking it out of a bullion dealer, because you are going to go into a queue. Now, it's not that you're not going to get it, it's just that you are going to wait a significant amount of time. And the additional reason to this is, we favor the futures markets. We've got to have good for delivery, because if we don't have good for delivery, then we create all sorts of problems of the paper system collapsing in on itself. So good for delivery will always be preferred over Joe Bloggs or somebody like me who wants their, just a few ounces taken out of that 400 ounce bar. And again, it's not that you won't get it. I don't want to cause a run on any gold bullion dealers. It's just that it will take time.
Yeah, and there was yes, Phil.
Yeah, no, that's so true, because I remember reading during the times where physical was so hard to get, Australia was shipping so much gold over to the US for their exchanges because a lot of the transactions before that was cash settled and not physically settled, but because of the arbitrage you were talking about before, they were yeah, no, I want my gold. And they were literally shipping physical gold from everywhere.
Yes, and this goes back to, I'm not supposed to be this excited about it, but the gold market fractured for the first time ever, and the on-demand supply chain absolutely fell apart. So normally we just basically take gold straight from South Africa. It goes up to England, or it goes to Switzerland, a refinery, and goes back to England into the vault, and then it goes straight over to America. That chain was fractured because South African mines weren't exporting, or mining for that matter. They all shut down. The Swiss refinery shut down for 3 weeks, which unprecedented. And you couldn't even get any gold stored at the UK over to the US because they'd already taken as much as they can to go settle those good for deliveries. So Australia filled that supply gap. We were very fortunate that we were able to do that. As a result, people like me who bought a bucket load of gold at the start of the year were in the queue. And I'll just reiterate that I have friends in high places at bullion dealers, and I could not queue jump, and I didn't get some of my gold delivered until July.
Oh, wow.
So that's how intense the wait was.
Yeah, I think the weight has eased a bit now, isn't it? it's
And it goes back to if you're interested in owning physical gold and silver, you don't wait till it's in the headlines. As I know, Lan, at the start of the conversation, you talked about there was a bit of nervousness around the price sell-off. Believe it or not, that nervousness is the opportunity.
Well, that's it. If you have a long-term view of your investments in gold, I remember, was it Mike Maloney or Jim Rickard said that he doesn't look at the price every month or every day. It's
Yep.
really look at the macro trend. We're in a bull cycle, so you got to have at least 5 to 10 years or whatever your investment time frame is. So if you have a long term, it shouldn't matter, and you buy in the dips.
Yeah, exactly. It's similar. It's a similar strategy to when you buy a house. You don't buy a house hoping it'll be worth twice as much 2 years from now or 20 years from now. You buy the house because that's an alternative way to store your wealth, and obviously you need somewhere to live. Gold is the same thing. I always look at any cash in gold as money put away for a decade at least.
Just to push that narrative out a little bit, Shae, how about that some people put forward that gold doesn't give you any return? So once you put your money in gold, it's pretty much stuck there. You don't really, if you take it back out of gold, then it starts losing its value again. So really, once you put your money in there, you never get it back.
Again, I'm going to quote somebody who told me, gold does so little, it doesn't even rust. Like gold does nothing. It is honestly a really pretty rock put underground somewhere. Like that's the best way of looking at it. And you're right, it does nothing. It doesn't pay a yield. But does every single investment we have need to pay a yield? Houses don't pay a yield. If you're living in it, it doesn't pay a yield, but you do hope that there's future growth from that. And that's what we're hoping with gold, is that while I believe gold is in a long-term bull market, obviously there's no guarantee until the future actually happens. I believe that any money put in gold is that even though I'm not getting a yield, I will receive long-term capital growth, or at the very least, I will have, purchasing power protection. So even if there is no capital growth, one of the truisms of gold is that it does protect your purchasing power.
Let's go more about that, because I think with these trillions of dollars printing from all around the world, including Australia, a Reserve Bank, purchasing power, protecting the purchasing power of the fiat currency, why is gold and silver such a good hedge against that? I mean, explore that a bit more.
Okay, so basically the short version of it is, I'll go back to 2008 when I bought, a pinstripe suit back when I was working in corporate for a derivatives firm, and a nice dinner, and that's supposedly what 1 ounce of gold should be able to buy you at your point, wherever you are in your life, should be able to buy you a nice suit followed by a nice dinner. And I can tell you right now, if I went and bought that suit now, it would still cost me 1 ounce of gold, and it would still have gone out and bought me a nice dinner, and I wouldn't have much change left over. So what gold does is, as governments deflate the value of the dollars in your wallet, and they do that through interest rates and increasing the supply of money in the system, gold tends to follow the purchasing power. So if you've got, you spend $10,000 on a car today, well, car's a bad idea because there's awful deflation in that one. So look, the short version is that gold can buy you the same amount as your $20 today, as that, in the future, that same amount of goods, regardless of the dollar value of the notes you're using to exchange for it. Did I clear that up a bit better?
Yeah, I think you did cover it, but I think people need to be aware also that their salaries are not going up as fast how's assets going up faster with the supply of money increasing doesn't help, and people probably won't see that until when it's too late. So they are seeing it in when they go shopping, prices going up with fruit and veg, but how are they hedging against that? So gold and silver and just alternative assets is a good way of making sure that you retain and preserve some of that purchasing power. That's what I was trying to get people to be awake and aware that they should do something right now. And you just gave an example about the 1 ounce of gold is worth 1 ounce of gold in the future, whereas let's say $20 today is not going to be by much, or actually nothing right now anyway. Now, isn't it? Yeah. So $100 going to Coles and Woolworths is not going to buy you much right now. Shopping cart like a few years ago. So that is what we're discussing: purchasing power and the fight against inflation. So yes. Now, Shae, I know you're an expert in mining stocks, and what's your, I guess, guidance to newbies who don't own any mining stocks at the moment? Where should they start?
Oh, okay. Look, all right, I'm going to stick specifically with gold mining stocks because that really is my forte right now. When it comes to mining stocks, you need to decide how you feel about getting your money back. And that often I find will dictate where people put their money in. So for example, producers, they're more likely to, you're more likely if you invest $1,000 in it, chances are in a major gold mining producer, you'll get that money back. A developer, there is a risk that the mine will never come on site, or that if it does, it might not produce as much as they told the market it would. And then you've got the explorers, which any money you put in an exploration stock, you kiss goodbye. And then you just have to hope that you've done your homework, your due diligence, and you'll see it. So they're the rules that I take. So as I said, I'm invested in gold mining stocks across Australia. And my absolute recommendation is if you decide to dabble in exploration stocks, any money you invest in that, you automatically you have to decide, can I live without it? Because they are so risky that you cannot guarantee that you'll even get it back. They delist frequently, they go bankrupt frequently. Like, it's not a place for beginners, but by all means watch it. Don't be put off, but watch it. And don't worry about, and the other thing with exploration stocks is people see triple digit gains and they think, oh wow, 300%, I want some of that. But how would you feel about losing that $1,000? So it's a very risk adverse, it's a high risk sector, and I don't recommend people should start there. I always think people should look at developers or producers as great starting points. Australia is absolutely spoilt for choice when it comes to our gold mining mid-tier sector. We have some incredible companies. They are cashed up to the eyeballs. They are pouring gold very cheaply. So a couple of basic tips if you are looking for a gold miner or a soon-to-be producer is look at the all-in sustaining cost. Now, the all-in sustaining cost is how much it costs to get that ounce out of the ground, but also to all the company corporate costs attached on that. Pretty much, didn't have the numbers ready, but off the top of my head, the last time I did the analysis, all top 10 gold miners in Australia could produce an ounce of gold for less than $1,500 in Aussie dollars. So that means that even with our currency getting stronger and the gold price falling in our currency, they're still basically making you on $1,000 an ounce. That's where you want to start. You want to look at that. The next thing you want to look at is their forward guidance. And, that's a fancy word for how much gold do they think they're going to pump out next year. You want to look at a company who is looking for growth. So if a company is producing 300,000 ounces this year, look at what their estimate is for 2021. Chances are they might put out something that's 50,000 ounces higher, or even 100,000 ounces higher. A company that's trying to increase the amount of output is a very strong sign that there's going to be further capital growth in the share price. So they would be my best tips for looking at a company, for if you're looking at producers. Oh, that and cash. One of my favorite things about computers is Control F. When you go to their cash balance sheet, just hit Control F and type in the word cash, and you'll see cash on hand. And all of our gold miners should have cash in the bank. If we've got a gold miner in Australia that's in the top 10 or even top 15 that doesn't have cash in the bank, walk away. They're making a lot of money at the moment, so we need to see that they're using it effectively. Now, some of them could be storing a lot of cash, because I'm hearing the increasing likelihood there'll be some takeovers and mergers in the top 10 to 15, but I don't think they will be ones where we see companies offering a premium for the other company. I think what investors should prepare themselves for is that we'll see a lot of mergers like Saracen and Northern Star, where they called it a merger of equals, even though it's absolutely not a merger of equals. I mean, it was a $10 billion company merging with a $4 billion company. So it wasn't a merger of equals. It was a friendly merger, but already we're seeing, consistent share price growth, even though there was no premium offered. And that's not such a bad strategy to employ. And this is taking it one step further, is that I do anticipate there will be mergers in the top 10 to top 15. But our miners need to get bigger. That's the absolute crux of it. We don't really have many global competitors, and we absolutely should. We have some of the best run gold miners in the world. I believe we're going to see these mergers so they become, global giants that can be recognized internationally, especially too when you look at companies like Evolution and Northern Star, for example. They're starting to pick up international assets. Yep. So getting bigger will give them a better reputation, mostly in the North American market. So that would be my tips for moving into producers. With developers, look, if you're investing in a developer, look, they're burning through cash at this stage, and they are going to be taking on a lot of debt. So again, that's something that could act as a deterrent for investors when you see a company with a lot of debt. What you want to do is you want to look at who's involved. Again, we've got an incredible group of people getting a lot of our companies up and running. But I would look at the projections for the all-in sustaining cost and how long that mine is going to take to get online. I know Calidus Resources is the next company that will be pouring gold in Australia. That's due to come online next year in the first quarter, I believe. Look at what the time frame is if you're looking for share price growth. And these are all things that can be found quite easily in a company's update. You just got to do a little bit of legwork, but you want to find a company that says that they're going to come online either in the next 12 to 18 months. If they don't have a set time frame, maybe put that company on your watch list and come back and visit at a later date. Just because if it hasn't set a time frame of when it's going to start pouring gold, it might have the same sort of risk level attached to it that an explorer does, just because they haven't set that hard date in the market.
That's it. And you know what? You've done all that research for the investors. Yeah. So if you're thinking of putting an allocation in mining stocks or gold, Shae has a newsletter, and she all those, because I'm not going to ask what recommendation, because there's no point, because each month there are different recommendations you give. So for those who want to learn more, how can they get involved? Be in touch with you.
Oh, okay. So you can go to our website, which is fattailmedia.com.au. Rockstock Insider is not the premium. It's the entry level one. I think it's about $70 a year. And that's if you've got no clue on what you're doing. That's the entry level one. But also too, there's a lot of great, I appreciate the glow up, don't get me wrong. There's a lot of great free resources out there, because there's no point just having somebody telling you what to do, especially when it comes to mining stocks. You need to be prepared to learn a little bit more about it, because if you don't learn what went wrong, then you can't learn to become a better investor. And while I might feel a knowledge gap, I'm not an oracle. I don't have all the answers, but I definitely try to, put as much information out there as possible.
That's right. And you have a second one. So that was what's the second one? The advanced one?
The second hard money trader. Now that's a bit more expensive. That's about $2,000 a year. So that's getting up in price. And that is, again, the bloke and the shovel stocks. So they're the ones that are very, very high risk. They're the ones that might hit gold. Sometimes we're looking at companies that already have core samples and we can get an idea of how much gold is in the ground. Sometimes we're talking about companies that still have geos out on the field, literally scooping up little bits of rocks and taking them back to be assayed. So it's much more high risk, and it's certainly not for everybody, because again, any money put in these stocks, there's a good chance you'll never see it again. So, unfortunately, there's no middle ground newsletter. That's something I would like to work on, something for that people who are sort of comfortable with mining stocks but still don't really want to kiss their money goodbye away just yet. That might be a project for next year.
So just with the level of risk in the the geo stocks and things like that, like what got you excited in that area? Was there something that happened that got you excited, and there's an experience with a certain company, or it is a very niche part of the market?
Yes, it is actually, and that's such a good question, and nobody's ever asked me that. Again, I think this is where it comes back to my undiscovered love of rocks. Well, it's discovered now. A few years ago, I was starting to read a lot about Australia's how gold was discovered in Australia, and we've got some incredible stories for both gold, all the major gold rushes. In the Victorian goldfield, people were literally pulling nuggets out of rivers, and over in Western Australia, the Norseman mine, for example, was discovered because a guy's horse kicked over a rock with his hoof, and it turned out it wasn't a rock, it was a lump of gold. So I think my love of these explorers actually started with reading a little bit about Australia's history, and the more I started incidentally talking to international experts about Australia. Rick Rule's a huge advocate, he's one of them. He incidentally pointed me in certain directions where he's like, do you know how underexplored Australia is? And I went, oh really? So I a few years ago I went away and investigated it, and that was when I started realizing that especially in Australia, we know so little about what's in the ground, and the reason why is because we didn't need to work that hard. Australia is vastly underexplored, and I've said this in a few different forums now. Our average mine depth across Australia is, granted there are deeper mines, is around 300 meters, which is nothing. It's absolutely nothing. It's like scratching the surface. So that was what made me think, wow, look at all these. Most people see them as dodgy little companies, all the explorers in the ASX. I saw them as opportunities. So they were the ones. It was sort of a slow progress, really, to make me go, I wonder what's underground. And then the more I learn about geology, and as I said, I'm a part-time student again, as well as a full-time employee, the more I realized how exciting the opportunities in particular in Australia were. So it was a slow evolution.
Yeah.
Is there an element of that asymmetric return that excites you as well in that, compared to
Look, yes. Yeah. It is absolutely the thrill of the find. I love exploring. I four-wheel drive. I camp. While I don't have much fieldwork experience, I've always loved to try new things. It's how there are some people who are just risk adverse. Well, my answer is I'm just too stupid to say no. I see an opportunity and I say yes, and then I work out later on if I've done the wrong thing or not. So it absolutely is the thrill of the find, and that it's that adverse risk. It all could blow up in my face, or it could all turn out to be incredibly exciting.
Yeah, I like to ask. I mean, I keep on saying to finish off the last question, but so much what we want to ask you is that when will mining stocks get that 10x or 100x? Is it the gold price have to move a bit more before we see that parabolic move in mining stocks? I mean, I read you said in the last bull run that's what happened, but we're not seeing that yet, right? So when do you, in your opinion, forecast that to happen in this bull run? Yeah.
What year? Oh God, if I knew that. Look, it is definitely, so there's normally a traditional cycle, and again we're going to use March to August this year as a little bit of a sneak peek for what can happen. So normally there's a cycle. The gold price rises, then it takes the producers with it, and 6 to 12 months later the developers go with it, and the very tail end of that gold price parabolic rise tends to be the explorers, right? And that's when it sort of lifts everything up. And normally that can be a 1 to 3 years price cycle. Normally it takes a long time. But if we go back to March and August this year, which arguably, again, it was unprecedented, but it does give us an insight to investor behavior now, especially given that there's no interest rate at the bank. From March, the producers, if you go back to the lows, took off like a rocket. Like gold had barely moved, and companies like Newcrest, Evolution, Santa Barbara, all the companies that had been very heavily sold off rallied very strongly on the back of that gold rally. So normally it would be a much slower transition. Now, developers followed behind quite quickly. You know, they were starting to see new highs by April and May, but at the same time, exploration stocks lifted off with the developers as well. Interestingly, and I don't want to bore people, but I sometimes I know a lot of things and I never know who's going to want to know what. Now, again, back in August, back in March and April, the ASX actually changed the capital raising requirements for small companies, allowing them to, you know, not get shareholder approval because we didn't know what was happening. There was a concern that, you know, most of the companies would go under on the ASX if they couldn't get cash, if there was going to be a liquidity crisis. There was no liquidity crisis. We didn't know that at the time, though. So the ASX loosened the rules so that slightly larger amounts could be asked, and they didn't need shareholder approval. So millions and millions and millions of investor dollars flowed into exploration stocks not long after the market was crashing, which is again, there's that word of 2020, unprecedented, but it is unusual investor behavior, because you would think if the market was crashing, the last thing investors would want to do is put their money in exploration stocks. What helped that bounce in exploration stocks was obviously the gold price rising, but also to producers and developers taking off with it. And it took exploration stocks, and it took a lot of hot money into the market at that time. So the cycle that should have played out over 1 to 3 years really played out over 4 months. But if you follow that pattern, you can see that that is what you can expect to happen a couple of years from now. I think by seeing all that money sucked into the market back between March and August, it's basically brought forward in money that it would have asked for, you know, going into 2021 and 2022. So I don't expect to see an absolute mania phase for a few more years yet. I do think once the gold price starts to rise again, we will see the normal investor cycle of producers, developers, explorers, increasing slowly before a parabolic move. And I do think it's because a lot of that money got sucked into it early. In saying that, the exploration market, my view is it continues to look quite hot. It has sold off because of the gold price, but there's a lot of good news expected to come in the next 6 months. Sorry, the first 6 months of 2021. And it's simply because a lot of exploration was put on hold because of COVID. So, you know, there were state borders, so people couldn't cross them. There were intrastate borders in places like Perth and Northern Territory. And not only that, there's a shortage of drill rigs and staff. So while there's a lot of hot money flowing into exploration right now, I think the next 6 months of 2021 will still see the exploration sector quite hot. But the parabolic moves that we see in miners across the spectrum, I do think that's going to be a good couple of years away.
Okay, and there you have it. So for those who, it's not too late to still research and get into, and could be at the bottom. Well, the bottom as Shae. But it was good in March. But unless we come up with something else happen in 2021, knock on wood. But I really enjoyed having you on the show, Shae. As you know, off camera, we've been following your work for a long time. Thank you. We could invite you in next year, like and see where it's tracking. That would be fantastic. So I do recommend Shae's work, because I'm also a subscriber, and she has the entry one, which is great, because that's where you'll get to learn recommendations and where you could start. But Shae, any last words for our viewers?
Oh, do you know what? If you're nervous about investing in precious metals like gold and silver, start with silver because it's cheap. Sometimes you need to get around the psychological idea of putting $2,500 in a lump of metal, but silver's $33 an ounce. So it's a much easier way to ease yourself into the idea of owning physical precious metals. And from there, you'll decide whether it's for you or not for you.
Everyone can afford $33, right? For a week.
Money in that. So.
Excellent. All right. Thanks again, Shae, and all the best with your work. And I look forward to seeing your community grow even more, because hopefully we are right about this bull run in a couple of years, and we don't, everyone is getting into the bottom. That's all I can say. Phil, thank you again.
Thank you.
Thank you for having me. This has been great.
Yeah, thanks. That's it for this show. And as I said, we will put Shae's links and works at the bottom of our video if you want to get in contact with Shae or have any further questions. But definitely check out her her subscriptions and learn more about it. Okay, bye. Thank you.
Bye.
Shae.